Hey guys, Joe here with another episode of 4 Minute Finance. Today we're going to talk about capital gains. It's something that is actually quite easy and simple to understand once you're educated around it, but it is often something that clients simply don't have on their radar. So when we advise them or bring up something that is related to having some thoughts around capital gains, it's always a situation where they're going, that wasn't even on my radar, I wasn't thinking about that. So I find it to be quite helpful, but also very easy to understand, okay? Capital gains are simply if you buy an asset or investment and then sell it down the road for a gain, right? Higher than we originally bought that asset for. The difference is the gain, okay? And the IRS is going to take their portion of that gain in the form of a capital gains tax. Okay, there are two types. There are short-term capital gain tax, and there are long-term capital gains tax. Depending on how long you hold that asset, depends on which category it falls into. If it is 365 days or less, that is going to be a short-term capital gain. If you hold that asset for 366 days, right, 1 day longer than a year, you're going to be taxed at a long-term capital gains rate tax. Okay, so what are those rates in 2019? They are based on your income. Okay, for a long-term capital gains tax, the IRS is going to typically benefit you for holding that asset for longer than a year. The only reason I say typically is because for most clients that are buying and selling assets at a gain, the long-term rate is going to be more favorable than the short-term rate. The long-term capital gains rate, if you make as a single individual under $39,000 a year, it's 0%. If you make above $39,000 up until $434,000 of income, most of us, 15%. Okay, and if you make above $434,000 of income in a given year, you're taxed at 20%. Okay, so for the majority of clients that we're talking to this about, we're usually at that 15%. So that's where that falls in, 15% there. If it is a short-term capital gain, okay, if you buy and sell that asset within 1 year, whatever the gain is going to be tacked on to your income at the marginal tax bracket. Your marginal tax bracket, explained in another video how tax brackets work, right? But your marginal tax bracket is your highest rate of income tax that you're paying in that given year. Typically higher than a 15% rate there on the long-term side, okay? So that is the difference. It is the duration that you hold the asset for, and it is the rate at which you're going to pay based on how long you did hold that. Okay. As always, please subscribe, like, comment, ask any questions. I will respond to any questions you guys ask. Hope that was simple and helpful and something you guys can keep in mind moving forward so that we can pay less money to the IRS and keep more of those assets for yourself. So have a great day.